Bond portfolio performance refers to how well a collection of bonds, a bond portfolio, is doing in terms of generating returns for the investors. It typically looks at factors like total return or interest income plus price changes, risk levels, and comparison to benchmarks. So bond portfolio performance shows how much money the bond investments are making and how stable or risky they are. Bond portfolio style is a simple way to describe how a bond portfolio is managed. It usually refers to types of bonds held like government, corporate, or high yield, maturity like short, medium, or long term, credit quality like high quality versus riskier bonds, and strategy like active versus passive management. So bond portfolio style tells you the flavor or approach of the bond investing strategy. Bond portfolio strategies are approaches used by investors to manage a collection of bonds to achieve specific financial goals, such as maximizing returns, minimizing risk, or matching future liabilities. So this chart compares the risk or volatility and return of various asset classes, including different bond portfolios. It shows that bond portfolios like CityUS Government Bond, CityUS Corporate Bond, City World Government Bond, and CityUS High Yield Bond generally have lower volatility or risk than other asset classes like stocks, S&P 500, Russell 1000, MSCI World Equity, MSCI Emerging Marketing Equity, and real estate like FTSE, NEREIT. While the returns for bonds are lower than those of equities, they are also less volatile, indicating a trade-off between risk and potential reward. US Treasury bills or T-bills show the lowest return and volatility, representing a very low-risk investment. Inflation is also shown as a benchmark, illustrating the real return or return above inflation of each asset class. So this grid categorizes fixed income investment based on two key characteristics. First is credit quality, ranging from high grade to low grade. Second is average duration, the short term, intermediate term, and long term. Each cell represents a specific investment style. For example, high grade over short term would indicate bonds with high credit ratings and short maturities. The BCA index is likely a benchmark used for comparison within this framework. This grid helps investors understand the risk and return profile associated with different fixed income strategies. Passive management strategies are investment approaches where a portfolio is designed to match the performance of a market index rather than trying to outperform it. The goal is long-term growth with minimal trading and lower cost. Buy and hold strategies, purchasing bonds and holding them until maturity. Indexing, creating a bond portfolio that mirrors a bond market index. So this table compares three index bond investment options: a Barclays US Aggregate Index, a Vanguard Total Bond Index Fund, and an iShares Barclays US Aggregate ETF as of January 2011. All three are classified as high, grade, or intermediate term. Table details key characteristics including the numbers of holdings, annual turnover, annual yield, average duration and maturity, credit quality breakdown like percentage of portfolio in government, agency, AAA, AA, A, BBB, and other are not rated, tracking error, and expense ratio. The data reveals differences in the number of holdings, portfolio composition by credit rating, and expense ratios, allowing investors to compare the characteristics of these similar but not identical investment choices. Active management strategies involve frequently buying and selling investments in an attempt to outperform the market or specific benchmark. In bond portfolios, this means adjusting the mix of bonds based on the interest rates forecast, credit quality, or market conditions, aiming to maximize returns or minimize risk through carefully timing and selection. This strategy relies on the manager's skill to make profitable decisions based on the market analysis. So this table assesses various active bond portfolio strategies based on four criteria: the scalability or ease of increasing portfolio size, sustainability or long-term viability of the strategy, risk-adjusted performance rated 1 to 10 with 10 being high, and the presence of extreme values, yes or no. Each row represents a different strategy source, such as interest rate anticipation using duration or yield curve analysis, valuation analysis focusing on security selection or anomaly capture, credit risk assessment, yield spread analysis, and global or tactical approaches like sector, country and currency allocation. So the table provides a subjective evaluation of these strategies, highlighting their strengths and weaknesses across different dimensions. Interest rate anticipation is a bond investment strategy where investors adjust their portfolios based on expected changes in interest rates. If interest rates are expected to rise, they may buy short-term bonds to reduce losses. If rates are expected to fall, they may buy long-term bonds to lock in higher prices. So the goal is to earn better returns by predicting interest rate movements. So this table describes a paired transaction by an active bond portfolio manager illustrating a specific trading strategy. The scenario assumes a flat yield curve, US Treasury bonds at 4.75%. The manager simultaneously bought one US government bond with a 7-year maturity, an 8% coupon rate, and a modified duration of 5.438, and sold another US government bond with a 13-year maturity, 0% coupon rate, and a modified duration of 12.698. This paired trade likely aims to profit from anticipated changes in interest rates or the yield curve, exploiting a perceived mispricing between the two bonds. So this chart shows two possible future yield curve scenarios, scenario number 1 and scenario number 2, compared to an original yield curve, relevant to a duration reducing active bond trade. The x-axis represents bond maturity in years, while the y-axis shows the yield to maturity. Both scenarios show an increase in yields at both the 7-year and 13-year maturities compared to the original curve. Scenario number 1 shows a smaller increase with 35 basis points at 7 years and 50 basis points at 13 years. Scenario number 2 shows a larger increase with 50 basis points at 7 years and 75 basis points at 13 years. So these scenarios illustrate how a duration reducing trade might profit if yields shift as predicted in either scenario. The shorter duration bonds would benefit more from the yield increases than the longer duration bonds. Valuation analysis is the process of determining the fair value of an investment, like a bond, by analyzing its features such as interest payments, risk, and time maturity, and comparing it to its market price. The goal is to find out if the bond is overvalued, undervalued, or fairly priced to make a smart investment decisions. Credit analysis is the process of evaluating a bond issuer's ability to repay its debt on time. It looks at the issuer's financial health, credit rating, and risk of default to decide how safe or risky the bond investment is. Credit analysis of high-yield junk bonds involves evaluating the financial stability and risk of issuers with lower credit ratings, BB+ or lower. These bonds offer higher interest rates to compensate for the increased risk of default. The analysis focuses on the issuer's financial condition, cash flow, debt levels, and overall ability to meet debt obligations, as these factors determine the likelihood of default. So this chart displays the monthly yield spread history from 1985 to 2011 of Citigroup High Yield Market Index versus a constant maturity 10-year Treasury bond. The y-axis represents the spread in basis points, indicating the difference in yield between the high-yield corporate bond index and the benchmark 10-year Treasury. The chart shows significant fluctuations in the yield spread over time, reflecting changes in investor risk, appetite, and credit conditions. The spread widened considerably during periods of economic uncertainty or financial crisis, such as peaking around 2009, then narrowed during more stable periods, suggesting that the high-yield corporate bond market's risk premium varies significantly over time. Investing in default debt involves purchasing bonds or loans from issuers that have failed to meet their debt obligations, often at a significantly reduced price. Investors in default debt hope to profit by either the issuer recovering financially or restructuring the debt to receive some repayment, though this comes with high risk of loss. Credit analysis models are tools used to evaluate the creditworthiness of a borrower or bond issuer. These models analyze financial data such as income, debt levels, cash flow, and other factors to assess the likelihood of default. The Altman Z-score model, a financial tool used to predict corporate bankruptcy. The model uses a formula Z is equal to A0 plus A1x1 plus A2x2 and so on and so forth, combining 7 financial ratios: the profitability, normalized profitability, debt service capabilities, cumulative profitability, liquidity, capitalization, and size to generate an overall credit score. Higher Z-scores indicate lower risk of bankruptcy. This exhibit presents Altman Z-score analysis for two companies, Ford Motor and Kronos Worldwide, as of September 9, 2010. The analysis uses the Altman Z-score model to assess each company's financial health and bankruptcy risk. The table shows the input financial data, example, earnings, assets, and liabilities, used in the calculation along with the resulting Z-score and a double prime Z-score, a modified version. A graph displays the Z-score history for each company over time, providing a visual representation of their financial risk profile. Lower Z-score suggests a higher risk of bankruptcy. In this example, both companies have relatively low Z-scores, indicating some level of financial distress. The exhibit's data and charts allow for a comparison of two companies' relative financial health and risk profiles. Yield spread analysis is the process of comparing the yields, interest rates of two different bonds or debt securities to assess their relative risk. Typically, it involves comparing a bond's yield to a risk-free benchmark, like government bonds. A wider spread indicates higher perceived risk, while a narrower spread suggests lower risk. This analysis helps investors make decisions based on relative risk and return. Implementing an active bond transaction involves buying or selling bonds based on market conditions, interest rates forecast, or credit analysis in an effort to outperform the market or a benchmark. This strategy requires actively managing the bond portfolio, making decisions about selection, timing, and adjustment to take advantage of opportunities and minimize risk. A pure yield pickup swap is a strategy where an investor sells a lower yielding bond and buys a higher yielding bond, typically of similar risk and maturity, to increase the overall yield of their bond portfolio. This strategy focuses solely on increasing income without changing the overall risk profile significantly. It's often done when market conditions allow for better yields on similar bonds. A substitution swap is a bond strategy where an investor sells one bond and buys another with similar characteristics, such as maturity or credit quality, but potentially better features, like higher yield or better price. The goal is to improve the portfolio's return or risk profile without significantly changing the overall investment strategy. This exhibit illustrates a pure yield pickup swap, a bond swap strategy. It involves exchanging a lower coupon bond, example, current hold, 30-year, 10% coupon, priced at $874.12, yielding 11.5%. For a higher coupon bond of similar quality and maturity, candidate hold 30-year, AA-rated, 12% coupon, priced at $1,000, yielding 12%. The table compares the financial aspects of both bonds, showing the higher coupon payments and total accrued value from the candidate bond. The swap's advantage is the immediate increase in yield, eliminating the need for market timing or price analysis. However, a key disadvantage is the book loss incurred from selling the current bond below its purchase price. In this case, $125.88. A tax swap is a strategy where an investor sells a bond to realize a loss for tax purposes and then buys a similar bond to maintain the portfolio's overall position. The goal is to offset gains with losses to reduce taxable income while still holding a similar investment. This strategy is commonly used to minimize taxes on capital gains. This exhibit describes a substitution swap, a bond swap strategy that takes advantage of temporary market anomalies in yield spreads between bonds with equivalent coupon, quality, and maturity. The example shows swapping a 30-year AA-rated bond with a 12% coupon, priced at $1,000, yielding 12%, for another 30-year AA-rated bond with a 12% coupon, priced at $984.08, yielding 12.2%. The table compares the financial aspects of both bonds over a one-year period, highlighting a total gain of $123.60 for both. The key benefit is the additional 171 basis points of yield pickup and capital gains realized when the market anomaly corrects itself. However, this strategy carries risk. The yield spread anomaly might be permanent, reducing capital gains, and market interest rates could change adversely. This exhibit explains a tax swap strategy in bond investing. It's used to offset capital gains from other investments by strategically creating a capital loss. The example involves selling $50,000 worth of corporate bonds that have a current market value lower than the purchase price, generating a $10,000 capital gains tax liability. Simultaneously, the investor sells bonds with a higher current market value than purchase price, creating a $10,000 capital loss. This loss offsets the capital gains, reducing the overall tax liability. Finally, the investor uses the proceeds to buy similar bonds, maintaining the same investment position but with a reduced tax burden. The net result is a $10,000 reduction in capital gains tax liability. Active global bond investing involves buying and selling bonds from different countries in order to take advantage of global market conditions, interest rates changes, and currency fluctuations. This table outlines a UBS global bond portfolio strategy comparing market allocation and currency allocation against a benchmark. It shows the percentage allocation for various regions: North America, EMU, other Europe, UK, Japan, Australia, and Singapore under two scenarios: a global portfolio and a global excluding US portfolio. The over or underweight columns indicate the portfolio's manager's deviations from the benchmark allocation for each region. For instance, in the global portfolio, the US is underweighted by 2.10%, while Japan is overweighted by 2%. The currency allocation section shows the intended percentage allocation of different currencies across the portfolio, demonstrating a strategic approach to global bond investing. The second set of data shows a more neutral approach with allocations closer to the benchmark. A similar comparison is done for the EMU countries like Australia, Belgium, Finland, and etc. Core Plus management strategies involve maintaining a core bond portfolio of high quality, low risk bonds while also adding a smaller allocation of higher risk, high return assets such as high yield or emerging market bonds to enhance overall returns. This approach balances stability with the potential for high yields, allowing for moderate risk, taking beyond the core but still focusing on steady income. This table compares the characteristics of core and core plus bond investment strategies. Part A shows typically portfolio composition, breaking down the percentage allocation across different bond sectors, like treasury or agency, mortgage-backed, asset-backed, investment-grade, corporate, high-yield, euro-dollar, and other, for both strategies and Barclays US aggregate benchmark. Core plus strategies include a wider range of sectors than core strategies. Part B contrasts investment mandates, showing that core plus strategies aim for higher excess returns, 100 to 125 basis points versus 35 to 70 basis points, and have higher tracking error and non-benchmark exposures compared to core strategies. Management fees are also typically higher core plus funds. The data highlights the differences in risk and return profiles between these two investment approaches.
Next is funding management strategies. So, this section explores strategies for managing investment portfolios to ensure that future cash flows match anticipated liabilities. Dedicated portfolios. So, a dedicated portfolio is an investment strategy where the cash flows generated by the portfolio are designed to match the anticipated liabilities of the investor. So, this means that portfolio is structured to provide necessary funds at the right time to meet future obligations. So the dedicated portfolios are commonly used by pension funds, insurance companies, and individuals planning for retirement. Next is immunization strategies. So immunization strategies are risk mitigation techniques used to protect investment portfolios from the impact of interest rate fluctuation. So these strategies aim to minimize the impact of interest rate changes on the portfolio's value and ensure that the investor can meet their future liabilities. So we have types of immunization strategies: classical immunization and interest rate risk, the mechanics of bond immunization, another view of immunization, application of classical immunization. So classical immunization. Excuse me. So this traditional approach involved matching the duration of assets with the duration of liabilities. So it assumes shift in the yield curve, meaning that all interest rates move in the same direction by the same amount. Next is contingent immunization. So this strategy combines active bond management with immunization techniques. So it allows for some flexibility in portfolio management while still providing a floor on returns. Next is the 19.5.3 horizon matching. So horizon matching is a hybrid immunization strategy that combines cash flow matching and duration matching. So it divides liability stream into two segments. The short-term liabilities are cash flow match, while ang long-term is liabilities are duration match. So this allows for a more flexible approach to manage interest rate risk while still ensuring that the investor can meet their obligation. Horizon matching. So, horizon matching is a hybrid immunization strategy that combines cash flow matching and duration matching. So, it divides liability stream into two segments. The short-term liabilities are cash flow match, while ang long-term is liabilities are duration match. So, this allows for a more flexible approach to manage interest rate risk while still ensuring that the investor can meet their obligation.
The summary outlines the evolution of bond portfolio management strategy over recent decades. A significant increase both of the number and variety of strategy has occurred, catering to individual and professional investors alike. This strategy ranges in complexity. For example, to create complex, they are categorized into five main steps: passive management, core plus management, matched funding, and contingent structured techniques. Passive approaches are further subdivided into buy and hold, selecting bonds with design characteristic and replacing them at maturity, and index mimicking and specific bond index, fully replicating in it of using certified something. Exhibit 19.19 illustrates classical immunization where the required asset millions of dollars are plotted against the yield level. Percent graph shows that within it a 5 years duration band, the required initial investment decrease as the yield increase. Contingent immunization modifies this, allowing cushion spread difference between the current market returns and floor rate, providing flexibility for active portfolio strategies. For example, if the clients accept a lower floor rate, the portfolio manager has additional funds to pursue active management, aiming to exceed the market returns while ensuring the portfolio's value meets the minimum requirements at the end of the investment horizon. Exhibit 2020 display the price behavior required for a floor return in contingent immunization, showing the required asset in millions of dollars plotted against the yield level percent. For both a 15% market rate and a 14% floor rate, the graph illustrates that if interest rate decline as expected, the value of a long duration portfolio while increase rapidly. Conversely, if rate increase, the portfolio value will decline, potentially falling below the level needed to reach that desired ending value. This highlights the risk and reward interest in contingent immunization strategies, where a caution is built into the strategy to allow for active management while still guaranteeing in minimum return. Exhibit 19.21 illustrates the safety margin in a portfolio of 30 years bond within a contingent immunization strategy. The graph plot asset in $1 million against yield level percent, showing the portfolio value, solid line, and the required asset for a 14% floor rate. Dash line, the shaded area represent a safety margin which acts as a buffer if markets rate decline, the portfolio value increases above the required asset. However, if rates rise, the portfolio value decreases until it reaches the trigger point at which classical immunization is implemented to ensure the desired ending value is achieved regardless of market fluctuation. This safety margin protects against unexpected interest rate increase. Exhibit 19.2 to illustrate the potential return concept in contingent immunization. The graph plots potential return percent against the immediate yield change from 15% percentage points. The curve shows that as the yield change from the 15%, potential return varies. If yield fall significantly, the potential return is higher than 14%, reflecting the benefits of active management. However, if yields rise, the potential return approaches the floor return, triggering a shift to classical immunization to guarantee at least the minimum return. This demonstrates the risk-reward balance and the productive nature of the categories of contingent immunization. Exhibit 1923 usually represent a contingent immunization floor portfolio performance. The graph shows the current value of the portfolio solid line and the required value of the immunization floor portfolio dashed line across 5 years. The shaded area significance the safety margin, illustrating the excess value maintained above minimum required value. This safety margin allows to active portfolio management while still granting the floor return. If the portfolio value ever drops, the required floor value active management excess and the current market rate to ensure the target ending value is met. Contingent immunization developed by Leibowitz and Weinberger is a bond portfolio management strategy that allows managers to pursue higher returns while utilizing classical immunization techniques to ensure a minimum return over the investment horizon. The strategy ensures the portfolio's value will reach a desired ending value even if interest rate change, making it particularly used for managing risk in volatile markets. The strategy relies on maintaining the portfolio modified duration equal to the remaining time horizon, ensuring that the portfolio price sensitivity aligns with desired return. This means that the initial investment required to reach the target value higher at lower yields, as demonstrated in the example provided.